Hello, Real Vision viewers. Today, I'm delighted to present Arthur Breitman. Arthur is the founder of Tezos, which many of you may know as one of the major Layer 1 blockchain networks. So Arthur, welcome to Real Vision.
Hi, thank you for having me.
Great pleasure. So before we get to the point at which you wrote and issued the 2014 paper, which outlined the vision for Tezos, can we go back through your career? It'd be good to hear where you came from. I know you've gone through finance, you've been through Goldman, Google X, Waymo. Can you just tell us your story before you founded Tezos?
Yeah. So I was born in France. I studied math and physics in France, moved to the US in around 2005. I did a master's in financial mathematics. And I worked on Wall Street, first working on startup and then specifically on high-frequency trading at Goldman Sachs, Morgan Stanley. I was mostly market making on some commodity futures, ETFs, and then on the option desk. And then around 2015-16, I wanted a bit of a change. I went to the West Coast and worked at Google X, which then spun out Waymo, which is a branch of Alphabet or Google that develops self-driving cars. So I had the great opportunity of working on left turns on the cars. And left turns are difficult because you don't necessarily get a light that tells you can turn. So it was a super cool experience. But at the same time, Tezos, which had been a bit of a hobby side project, started becoming huge in 2016. A lot of the thesis in the 2014 papers that you mentioned around governance and smart contract security, which were mostly theoretical construct at the time, was a paper was published, just became real events such as the block wars or the DAO hack or the Ethereum fork actually shed some light on some of the ideas in the paper, and so that gave a lot of traction to Tezos. And eventually I've been focusing full-time on this project for the past 4 years.
Thank you. That's a great introduction. So I think there are really a couple of things which mark out Tezos as completely distinguished from a lot of the other layer ones that we see. I think it's fair to say you took a very different, markedly different philosophy to other layer ones. I'd like to start on the governance side of things, and then maybe we can talk a little bit about the particulars of the smart contracts and the language, Michelson, that you've put into Tezos. So can we start back there? How does Tezos differ functionally from a governance perspective to the other layer ones that we see? So like Ethereum, Polkadot.
So there's different school of thoughts in terms of what to do with a protocol and how can a protocol change. There's one point of view, which is to say that if you're going to be decentralized, then your protocol cannot change. Because for it to change, someone would need the authority of asking for a change, and no one really has this authority. And so, in some sense, if you introduce a possibility for change, you introduce a possibility for capture or corruption. So change is bad. It's not a priori possible to have change in a decentralized manner. And even if you could have change, you need to guard against it because it's most likely will be used to harm your network as opposed to innovate. And that's I don't think that anyone who is a fervent advocate of Bitcoin, for example, feels that way. But generally speaking, it is one of the dominant ideology among the Bitcoin crowd to say, no, the algorithm is what it is. And, it's something that Satoshi said, the rules of the...
What we're showing you here on our YouTube channel is just the tip of the iceberg. No matter where you are in your financial journey, whether you're a beginner just looking to break into the market, or a financial professional looking to up your game, Real Vision has something for everyone. Every day, our team of expert journalists provides in-depth analysis, written reports, access to live streams, and access to our community, The Exchange, where you can interact with people just like you from all over the world. For just $1, you can unlock all of this and more at realvision.com. Try our Essential tier. If you like what you see, it's only $20 a month thereafter. So click on the link in the description, go to realvision.com, and see what you think. We look forward to seeing you there.
It is one of the dominant ideology among the Bitcoin crowd to say, no, the algorithm is what it is. And, it's something that Satoshi said, the rules of the Bitcoin blockchain were set in stone when the chain was launched. Not in those exact words. And there's another school of thought, which is to say, blockchains are meant to evolve, and it's fine to change the rules. We can hard fork, and the beauty of a hard fork, which is a governance model that predates, of course, blockchain. It comes from the open source world. The beauty of a hard fork is that we'll just have two versions, and then people can pick whatever they want. And one version will probably survive as a dominant one. The other one will probably periclite through lack of network effect. But at the end of the day, people will have made a choice, so you get some sort of market choice. And the difficulty with the fork model is that it's not really a free choice, in the sense that because the entire value of a cryptocurrency comes from network effect, and it comes from using the same thing that everyone else is using, it's a Schelling point. So in those networks, your incentive is not really to express your preference, it's to try to guess where everyone else is going to go. And it turns into a beauty contest. And as a result, one of the theses of the Tezos paper is that if you govern by hard fork, that gives centralizing tendencies. You don't actually protect yourself. So some people will basically have the power to coordinate those hard forks, and it can be, and it can create very, very sticky Schelling points. So what can we do? Can we get innovation without getting centralization? And the idea of Tezos is precisely to do that, to say, well, blockchains are actually good coordination devices. So let's use them as a coordination device for upgrading the rules. Hence the concept of on-chain governance introduced in the Tezos paper.
Got it. So the distinction here is, when you look at how, for example, Ethereum does an upgrade, obviously it looks, I suppose, optically to us like the European Commission and the Parliament, and the sort of Commission puts up these new proposals, and then the Parliament of miners, in this case, votes on them. And what you're saying is that this mechanism is actually directly ingrained into the layer one, rather than just sort of watching where the crowd of miners goes.
Well, I don't think the miners matter at all here. Like, the miners don't vote; they are not the one that matters. The only thing that matters in a fork is who values the currency or who doesn't value the currency. The miners, they have to pay for electricity. The miners are going to chase. It's not like mining does not make a currency valuable. Mining is profitable because the currency is valuable. So miners are going to want to mine the one which has value, and that depends on what people value. So miners have almost no say. And in fact, it would be impossible for, if that was the case, it wouldn't be possible for Ethereum to hard fork to proof of stake, for example, if somehow the miners were in charge. And they're not. If you look at who's in charge, it's whoever is capable of creating a strong enough Schelling point that people will say, well, yes, that would be the obvious one. If you look at an ecosystem like Ethereum today, some people who are capable of doing this are, people close to the Ethereum Foundation for historical reasons, and I don't think it makes them evil or anything like that. But I'm just saying as a matter of fact. But also exchanges. So exchanges are in a very strong position to decide which forks they are going to support and which one they will honor. But even stronger than that is all of the stablecoin issuer. So if there's a fork in Ethereum tomorrow, for example, USDC is going to have to decide where they're going to honor withdrawal. Because if you have a fork, then all of a sudden you double the supply of USDC. And so if I take one branch and I go and say, I want my tokens, and then on the other branch, I ask for my tokens, well, who gets them? And they're going to have to make a call. And all the contracts which depend on stablecoins, which is a lot of the DeFi ecosystem, is going to be completely broken if those coins are not redeemable anymore. So in some sense, there's a ton of power for anyone who issues real-world assets on the chain. And I don't expect, the thing is, I don't expect USDC to particularly want to wield that power. It just doesn't strike me as credible that they would start saying, playing Ethereum politics. But they are going to probably follow the crowd. And so whoever follows the crowd is already very, very powerful because they are going to be followed by USDC. So it creates a sort of situation where it might appear at first that no one's in charge because everyone's following everyone else. But if you follow the gradient, at the end of the day, you do have sort of like a kernel of decision-making power that exists. And that is, I think, a weakness of the forking model.
That makes sense. And I suppose in a kind of maybe softer landing way, you'd have things like MakerDAO. Again, the collateral would likely be underwater if you've got a sort of 50% LTV ratio. Collateral on at least one of those forks is going to be underwater at the moment that the fork occurs. Makes a lot of sense. So can we talk a little bit how much of the way that Tezos is governed right now had you sort of foreseen in that 2014 paper, and how much has it changed in the 7 years since you wrote that vision paper?
Well, it changed a bit, not fundamentally. There's been tweaks. So, for example, we used to have 4 periods of voting, and it's technical. It's like an approval voting, a waiting period, an approval voting, and then a binary vote, a waiting period, and a binary vote. And now there's a 5th period, which is I like to dub it, to get your shit together period. It's basically the period in which you know the proposal is going to go through, but it's not activated yet. And it was useful because they were proposals it was obvious that they were going to pass. They had massive supports and all the votes, but people were saying, well, I don't want to upgrade my library yet because I just don't know for sure it's going to pass. So now there's a 5th period. The timing has been compressed a little bit. There's also a phenomenon now where in order to move from phase 1 to phase 2, a proposal needs to get at least 5% approval. So there's been some tweaks to the governance model because it's also amendable, but by and large, it's very similar to the model proposed in the paper.
Got it. And did you ever have the problem with people not showing up to vote at the 2nd phase, or was that ever an issue?
Yeah, of course. We do get high participation, between like 60-80%, and of the bakers, which are like the block producers on the network. So it's very high, but not everyone participates. In particular, there are some large exchanges that do participate, like Kraken, for example. Kraken will abstain, but it counts as a vote. They're present. They're saying we're not going to voice an opinion, but we're here. And some exchanges don't vote at all. But in general, fairly high level of participation, and there's a quorum for proposal, but the quorum automatically adjusts. So if somehow a large fraction of the stake decided never to vote again, at some point the quorum will catch up, and it'll still be possible to vote.
I see, makes sense. And there's no prospect of any kind of slashing conditions over not voting or that sort of thing, or was that ever something that you looked at?
No, it's been proposed a couple times to have incentives for people to vote. So, paying people for voting would be one. The other one would be saying, hey, if you don't vote, maybe you don't lose money, but you can't create some blocks for a little while, some nudges. My main fear is that if you do that, you end up with people just, selecting auto voting. And they'll just I don't want to lose money, I'll press something. So I'd rather have a clear idea that the people who vote, voted because they wanted to vote and because they were here, rather than to try to get higher participation number, but it's not real participation. I think if the nudge is low, it has to be a nudge that's low enough that it's not worse for people to deploy some automated solution, but it's worse for them to actually look at the issue.
Right. So in some ways, you think the benefits of wanting to probability weight out the people who either don't know enough or don't care enough. I presume it's more not knowing enough than not caring enough in this case. But you want to kind of allow them to self-select out of the electorate.
Yeah.
So maybe for now we've covered the governance model. I wonder whether we can now move on to discussion around the smart contract platform. In particular, Michelson. Can you elaborate a little bit on how Michelson, for an engineer coming into Tezos, might differ from Solidity and maybe the additional security that it offers?
Yeah, and so the first thing is that I wouldn't compare Michelson to Solidity. I would say if it's closer to anything, it's closer to the EVM than it is to Solidity. It is a virtual machine, but it's so it's definitely much lower level than a language like Solidity, but it's also much higher level than something like the EVM. So it seems kind of in between. A good way to think about it is it's more like Bitcoin script, for example. But imagine you took Bitcoin script and you said, I want to make Bitcoin script statically typed, and I want to make it purely functional. Then you get something very close to Michelson. And so it is a virtual machine. And if you want to develop smart contracts on Tezos, many people who use high-level programming language, some of them have a syntax resembling JavaScript, some of them are based on Python. So there is this high-level language that people are more used to. So the question is, why have this kind of semi-high-level virtual machine as opposed to have basically an assembly language like the EVM? And I think there's pros and cons to both. Something that's nice with EVM is that it's very small, and so it's very you can quickly implement the EVM. It has a short specification, and it does it just does one job. It's not too hard to measure the gas cost of any operation, and it's very generic. You can program anything, so why would you need any higher level? Now let's look at some of the benefits of Michelson. So in Michelson, all your integers by default are arbitrary precision. So you're not, using this, you're not trying to shoehorn everything into a 256-bit integer. And the benefit is that, well, when you write your code, most of the time, you just want to use an arbitrary precision integer. And the overhead for doing it with a library like libgmp is very small. But it prevents shooting yourself in the foot with overflow bugs. And so I'd rather have a minimal performance overhead rather than having to deal with this. And also, if you're going to write some code, you want to write RSA code in Michelson, it's actually quite easy because you have this like very large precision integer, as opposed to trying to basically have to compile a big num library from Solidity to the EVM. So not having this overhead is important, especially because gas accounting actually takes quite a bit of resources. So when you execute a program in a VM environment for a smart contract, you need to account for the gas. How much gas is this costing? And computing the amount of gas it costs you actually can take more time than it takes to execute a smart contract. So you want to take large steps. If your step is doing, I'm going to do a zillion thing, and these are going to have a certain gas cost, that's one thing. If, on the other hand, you can have one instruction which does verifying a signature, hashing something, and you've calibrated the amount of gas for the instruction, you can potentially be much faster. So it's in a way, it's a little less elegant than having a very minimalistic language and just compiling everything to it. But you can have some performance benefit in doing so. And you also have some benefits in verification. So we have different tools which are oriented towards verifying the security of Michelson contracts. And the nice thing is, even if you use a high-level language, you compile down to Michelson, you can do you can use formal verification tool on Michelson. Now, you can also do it on DVM. There are frameworks like the K framework where you can do this, and there certainly have been. But for anyone who has practical experience in formal verification, it works by writing mathematical equations about your program. And if your program looks like a bunch of integers and then you're like swapping them and adding them, multiplying them, that's one thing. If all you're doing is shuffling 256-bit integers into a trie, there's a lot less structure that's apparent in your program, and so the proofs can be harder to make in this framework. So it makes it a little easier to prove things. And there's small things. So for example, having every leaf. So your data, I think in EVM is just like you have a trie, and every leaf is just 256 bits, which means that if you have a bit of data that you want to read that's longer than that, you're going to need to read 2 leaves. But a seek on a disk, even with an SSD, is pretty long. So you're better off. The reading cost on this on EVM is just like constant. Okay, I do a seek, I read this value. In Tezos, it's going to be an affine function. So you have a fixed cost for reading your leaf, but then the cost depends on the size of the leaf. Again, that's a benefit because you can store a little more data for the value. It adds complexity to the VM. That's a serious problem because we don't have that many implementation of the Michelson VM, and just like even modularizing the interpreter out of the protocol has been a challenge. So there are definitely costs to this approach, but some of the benefit is that in principle, you can optimize it quite a bit for performance.
Makes a lot of sense. Actually, can we just briefly return to the issue of form verification? Because I've heard about this, I've heard sort of 2 relatively opposed sides. For the viewer's sake, form verification is as Arthur was saying, is a sort of a mathematical way of essentially proving the correctness of a piece of code. You can tackle code security in a couple of ways. One might be form verification. One might be audit, where you've got people, expert engineers looking for bugs. But Prince, how do you think about what types of bugs? What kinds of particular big historic bugs that have resulted in massive loss of funds might have been protected had the code been submitted to form verification? Where can we, as sort of consumers of the technology, where are we likely to see the benefits, and what sort of settings is form verification going to pick this stuff up?
Oh well, there's a great history here. So there's a lot of research in formal verification in France. It's almost a joke because there's a large Tezos development team in France. And so, I do have a lot of contact with the French research community. And sometimes I will say like, oh, do we know any researcher in cryptography, or do we know any researcher in distributed system? And every single time it's like, oh yes, this person does formal verification of cryptographic system, and this person does formal verification of distributed systems. So there's a big focus on formal verification in France. And if you look at the history of it, it was started for the aeronautic industry and for the nuclear industry. And these have one thing in common, which is that the cost of mistakes is very, very high. There was an Ariane rocket that blew up. And the reason it blew up is because it had an accelerometer, and the accelerometer was measuring the acceleration. But because it was higher than the previous models, the counter had an overflow bug, which means all of a sudden, and when you have an overflow, you have a register, you have a like very large number becomes a negative number. So all of a sudden the rocket is like, wait a second, I am accelerating negatively. That's horrible. The rocket blew up because of that. And that's just because, you didn't have enough bits in your register to measure it. So this is typically the case where you're saying, let's look at the cost of bug divided by number of lines of code. And if that ratio is very, very high, then it's worth spending a lot of money making sure that the code is correct. And so that's one example. Not having rockets blew up is a very good use of formal verification. And there's many cases, of course, of smart contracts that blew up. I think smart contracts are even more drastic because you'll have smart contracts with hundreds of lines of code securing hundreds of millions or billions. And so the cost of mistake can be very, very high. Now, one thing to understand is that formal verification is not a silver bullet. It doesn't mean that you cannot have bugs. The best way to understand it is that it works like a ratchet. Once you see one category of bug, you know that there's a property that you want to verify. So once you see, for example, oh, I see, we can attack the system by using a reentrancy bug, like in the DAO hack. Okay, so from now on, I'm going to prove the property that I cannot if the contract is immune from reentrancy attacks. And I will add this to the list of properties that I want to verify. And whenever I do a formal verification of this contract, I will verify that this property holds. Or I will verify if I have an integer value that this integer value never overflows. That's just on my list. So it doesn't mean that you cannot have mistakes, but you get to learn from your mistakes a lot more. You end up having this list of properties that are very important that you need to verify. And if you verify those properties, then you've avoided entire classes of bugs. So it doesn't mean you cannot have bugs, but it means you can rule out large swaths of historical mistakes, which you wouldn't be able to do with just mere testing.
Right. So the future of smart contract security is sort of some combination of the heavy codification of mistakes we've learned in the past, and those can be formally verified, and then there's the sort of Zcash malleability bug type thing where you're going to need a human to catch that kind of thing.
Yeah. Again, it's just you gradually get there. Once you discover important properties, now you know that you always need to prove those properties.
Makes sense. Great. So, well, thank you. That's I think that's given us the coverage we need on the smart contract platform, and I'd like now to move on to just one other substructural item before we then start to talk about DeFi and where Tezos is going to sit in the future of decentralized finance. So, on the structural side, I just wanted to ask one question really, which is how does Tezos scale? Because obviously we've seen Ethereum creaking at the seams. And really kind of struggle to satiate the demand that's being made of it. How is that going to work on Tezos? I mean, really two components here. One is the sort of compute side, and the other is where is all the data going to go? And I guess there's the two big questions here.
Yeah. So there's different paths that can be taken to scaling, and I don't know what path Tezos is going to take because again, the governance is in the hand of stakeholders. I can tell you about some of my ideas for scaling, and in general, I don't believe that there is just like one true path for scaling. I think you need to pursue a portfolio of options and scale this way. One of these options, by the way, is scaling in terms of hardware. Let's just look at basic, simple on-chain scaling, requiring more computational resources from nodes, requiring more bandwidth from nodes. It's sort of against, some people see it as against their ethos, but you have to be quite pragmatic about it. So today, there are people with Raspberry Pis verifying the Tezos blockchain, and whenever they are upgrades to the chain, in general, that's been the standard that the development teams have been held, saying like, hey, you should still work on a Raspberry Pi. But that's something that could be reconsidered at some point. There may be a consideration that says like, well, we have this property that it fits on a Raspberry Pi, but do we really want that, or should we ask for higher hardware? And one thing to consider is that, so you have two types of nodes. Let's say nodes that produce blocks and nodes that don't produce blocks. And if you're a node that produces block, and if you're staking, and the minimum amount of stake is thousands of dollars, then asking for like $1,000, $2,000 worth of hardware doesn't seem to be completely crazy. Then the question becomes, okay, but if you do that, so that's for the node producing blocks, but what about light clients? What about other nodes who are merely following the network? And the question is like, how much demand is there really for this? There's not a whole lot of demand for light clients. People just don't use light clients. The only use case for light client that has been very validated has been other chains. Another chain might have a light client to a chain. So I'm not 100% convinced that people are going to use light clients. I think it's more bimodal. People either fall into the camp of, I am going to be a true cypherpunk. I am going to download everything myself and verify everything myself. For me, it's a matter of principle or even a way of life, and I don't mind investing a little bit in the hardware for doing so. Or they are, I have other things to do, and no, I do not believe that it's really different. I do not believe that, I don't know, like Coinbase is going to lie to me about what's going on in this node or this, and I'm fine with that. Yes, maybe if I do a very large transaction, I will take a little more security step, but that's fine. And I think people fall into these two categories, and there's not a whole lot of people who are saying like, well, I really want some light client type of security, but I don't need to download the full thing. So I think just scaling on chain is generally not the worst idea in the world. Even if you pursue a charting strategy, anything that you do, you'll still have some benefits in having more on-chain bandwidth, because most scaling proposals still use some form of like a beacon chain or some sort of chain for communication between shards. And the more capacity on this chain in general, the more scaling you're going to have. So I think it's fine to just do some of that. The other approaches are just like, generally speaking, side chains, where you don't really share the security, but you have a way to transmit state between chains. So that's one of the dominating model of the Cosmos ecosystem, for example. Tendermint is almost optimized for having chains be like clients of each other, which lets you move assets. The downside is that you don't share the security, you don't share the validation power in some sense. Every chain needs to come up with its own validators. But we see so many applications today on blockchains which demand a lot of throughput and do not demand a ton of censorship resistance. And so for this application, having a few set of validators that work is not really a problem. What they want is they want to be connected to a global permissionless network. They don't necessarily themselves be to have this level of censorship resistance. And so for these being on sidechains, for example, which connect to a main hub with a live client, I think is perfectly fine. And that's a great way to scale for a lot of like high throughput applications. A lot of the high throughput applications are also a lot of the not super censorship demanding, resistance demanding applications. So those are, and then you have, of course, L2 system. Like there used to be a lot of excitement around Plasma. I think, everyone sees now that there are some, there are quite a bit of downsides to Plasma. I don't think the lack of smart contract or the difficulty of making smart contract of Plasma is actually the main issue. I think the main issue is that people see that the exit game cost can be quite high. I like rollups a lot, both optimistic and of course ZK rollups. And in fact, I wrote an article in early 2017, called On Scaling Tezos, because a lot of people were asking me about sharding, and I was saying, look, sharding is interesting, but I don't see this coming anytime soon. And at the time, Ethereum was pushing very hard on saying, yes, we're going to be proof of stake, we're going to be sharded, it's coming very, very soon. And I wasn't reading any coherent proposal at the time regarding sharding. Like what I saw was validators rotation didn't make a lot of sense. It seemed very complex. It didn't seem like a realistic proposal at the time. And and in this article, I advocate basically for like, hey, there's a lot of low-hanging fruit for scaling on chain. So let's just start by doing that. Like computers are getting much faster. We can do a lot better than what we're doing. I think everyone's just being a little too conservative about what can be done on a chain. That's number one. And number two, people are talking about zero knowledge proofs for private transactions, but they're actually going to be a fantastic tool for scaling. So that was the theme of that blog post. And of course, one way to use this zero knowledge proof for scaling is DK rollups. So that blog post doesn't really touch on data availability. It mostly describes how you can have this other chain and you don't have to worry about safety because you just get these proofs which are posted that show that the thing is correct. The idea of a rollup is basically you solve the data availability by not really caring about it, by saying like, no, just put the data on chain and then we'll verify that it's correct. With optimistic rollup, with some sort of game similar to the type of thing described by TrueBit originally, you have some sort of challenge where you say, no, your validation is incorrect until you find one point of disagreement, or ZK where you're just supposed to prove that it's correct. And it might seem that you're not really sharding because, hey, you're just posting your data on chain. What's the big deal? Well, the big deal is a lot of the bottlenecks today are actually in validation time and not so much in bandwidth. If you require 10 megabits per second, which is not a lot. Most people with broadband today will have 100 megabit per second. And again, it's a bit of a political decision to decide if you need know anyone with a 56 kilobytes modem anywhere in the world needs to have access to this chain, or if you say we'd be better off if we required 10 megabit per second, for example. But if you do that, you scale to a very, very large number of transactions per second. If I think I don't want to do the math in my head because I might mess it up on air, but I think you get like into 100,000 transactions per second with a 10 megabit per second by compressing your transaction enough and aggregating signatures. So you get to like this very, very high number, and you're saying like, okay, so like bandwidth does not become a bottleneck for a while. Storage is not even worth discussing. Like, hard drives are just so cheap. Like storing of the chain is not even like worth considering. Your state size matters because it's helpful if it fits in RAM, but that comes down to validation time. And again, we've abstracted away the validation time with a rollup. So it's all about bandwidth. So I like rollups a lot. Sorry, I'm just like running in circles. It's so much more elegant to do a ZK rollup than an optimistic rollup. I love ZK rollups. The benefit of like posting a diff is overstated, I think. But the main problem with ZK rollups is just how long it takes to generate the proofs. That's a huge overhead. Even if you can parallelize it, I think it's still going to be a bit of a break on their deployment. And then so now let's talk about data availability. So how you shard that? How do you avoid everyone downloading every piece?
Can I just for the viewers sort of understand where we are is sort of the where we've just covered is the kind of the cost of compute. So this idea that you've got hundreds of thousands of nodes all around the world that are trying to ratify the same transactions, and that might be sending some cryptocurrency, or something way more complex like a smart contract. And so you've got to cure two types of scaling. One is a lot of which Arthur was just talking about, was different ways that you can scale the checking of that computation to make sure that the blockchain is able to digest it. And then on the other side, this kind of data availability situation, which is where data, it's fundamentally data that feeds into all these transactions and needs to sit somewhere, needs to be stored somewhere for the long term, and must never be forgotten in many cases. So just to kind of put this in context. Sorry,
I'm getting a lot in the weeds, but it's so interesting.
It's fascinating. This is one of the great accounts I've heard. So do continue.
Yeah. And so data availability, I think you have like you have different approaches. Again, there's a kind of the approach of saying like, well, let's try different things. So you could have one thing that's popular now is roll-ups with data availability committees, where you'll say, well, what we really worry about is people making fake transactions, but not really absconding with the data. We have a way of making sure we're getting the data. And so we'll trust a committee of people. We're not going to trust them to tell us that the transaction is validable. We'll trust them to tell us that, yes, they have downloaded the data and they have it. And you can generalize this idea of a data committee to your chain by saying, well, select a random amount of validators on our chain and we'll ask them to download the data for the rollup. So we won't ask everyone to download the data. We'll just ask a subset of people to download for the data. And if you do this, then all of a sudden you've sharded your bandwidth and you've sharded your computation. So there you go, sharding. The downside of this approach is that there is a thing, so it's adaptively corruptible. So you could go to the people who've downloaded this little piece of data and say, I will pay you to not reveal this data to anyone. And if you don't want that, there are more complicated schemes that have been especially championed by the Ethereum 2.0, which use error correction codes. So you can use some cryptographic trickery to make it so that you have to actually corrupt half of the validators to destroy any data, which is a very, very neat trick. I like to be incremental. I think just like the first one already gets you very, very far, and then cherry on top is you do the next one, and then you have a very, very very strong thing. You combine this with ZK rollups, you have a beautiful system. So that's the thing. It's like everyone's talking about how it's so hard for blockchains to scale and so on and so forth. I think people underestimate how much blockchains are going to scale. I think scaling is largely going to be solved in the next 2 or 3 years, and I think it's going to change the landscape of the L1s, because a lot of what we're seeing today is the result of chains not scaling in terms of what applications are being deployed, and in terms of competing ecosystems.
Well, this starts to kind of take us into the next area of conversation, because one question that's been asked a lot is, we're now seeing these DeFi networks, enormous amounts of liquidity, enormous amounts of capital being conveyed by these networks. And one of the things I notice in particular investors are terribly worried about, maybe we can just briefly touch on it before we go into kind of a full discussion on DeFi, is there's talk about Bulkanization of liquidity. And, are we going to end up with pockets of liquidity, let's say, Uniswap goes to Optimism or whatever it might be, and that they all end up in these little parishes of side chains or layer 2s or whatever it might be. To my mind, I would expect that there'll be relatively easy bridges between all these areas. But to what extent is that really a risk, or are we just getting kind of worried about something that's never going to be a worry?
I'll give the boring answer, which is that there are pressures for balkanization, which is everyone wants to start having a community pool and advertise it, and so you're gonna have many, and then you'll have aggregators who just route your order to many pools, and the extent to which. And so, of course, you might say, well, I don't want to pay the aggregators. There's a cost to routing, and so I'd rather route to the pool with the most capital, because it'll just be cheaper. And then you have a balance between just how much it costs to actually do the routing, how much overhead you add in having routing versus how much benefit you have in hitting the largest pool. And so at the end of the day, you reach some sort of equilibrium, which is neither complete fragmentation nor winner take all. What I find interesting is that if you look at US markets, for example, I'm talking about stock markets. So there was a regulation introduced in the early 2000 called Reg NMS, which basically said we don't want, the regulator said basically we don't want to have just the largest exchange take all the liquidity. We don't want to have sweetheart deals between sellers and brokers and buyers. So there's going to be just a national system where when you're a broker and you route an order, you have to look at all the exchanges which are out there and find the cheapest one, which was a way to guarantee some sort of competition between the exchanges. But it ended up creating a really funny thing where you can just be a tiny exchange and you make money by just selling access to people who legally have to look at the prices on your exchange. So I don't think we'll see anything like this in DeFi. But when I think of order routing, I think of Reg NMS for some reason. So, yeah.
Well, makes sense and good. Well, I would agree with you. I think the kind of the discussion about liquidity ending up in little silos feels an overblown worry. But can we now actually move into DeFi? In particular, one of the motivating reasons I kind of wanted to set up this interview was, aside from all the work you've done on Tezos, I saw probably one of the clearest outlines I've heard on a complete stablecoin thesis from you, which I think you published it in December last year. And before we go into the discussion, I'd just like to, so that any viewers who may or may not have been tracking stablecoins recently, really they fall into essentially three brackets, which is you've got something like USDC, which is collateralized on classical deposits or indirectly through classical deposits. You've then got fully collateralized stable coins. You've got some on-chain collateral, typically a cryptocurrency, without necessarily any other kind of economic content. And then you issue essentially some debt off the back of that, and that produces your price stability in the same way that it would actually the senior tranche in a CLO or a deposit in a bank. It's actually a very similar concept. And then we've had stalking the earth lately, the algo stablecoin. Basis rose first from the dead in 2017, has risen again, stalking the earth in the form of DSD, ESD, FEI, lots of novel approaches at algo stablecoins. And before we go into all those projects, I'd just love to hear, could you give us a sort of a succinct rendition of what you did in December and outline what you think are the basic principles behind a well-designed dollar or Swiss franc, whatever it might be, stablecoin?
Yeah, I think one thing that's useful for thinking about systems is having invariance in your head. Properties that must remain true, and then looking at the system through the lens of this property. So, for example, when you look at a physical system, one invariant is conservation of energy. If I'm looking at a machine, I say it has to conserve energy. And so if it doesn't conserve energy, I know there's something wrong with it. So if you give me a perpetual motion machine, I might say like, okay, let me see, like the wheel is turning this way. What about the magnet? I can look at that, but at the end of the day, I know it breaks an invariant. And because, because I know that the laws of Newtonian mechanics are, implies this invariant, I don't have to actually like compute all the forces. I know that, I'm going to get there mathematically as a result. There's interesting invariants in finance. Another one, by the way, is proof of stake. So for a long time, people say, well, proof of stake is impossible because imagine that you created an alternative to the chain that you just produce completely outside from the Genesis block, and then you have someone who appears for the first time and they see two chains and which one is the correct one. So that's a useful invariant where someone says like, oh, I have a way of doing XYZ. You think of that and you say, am I breaking this invariant? It turns out that this property is not, for proof of stake, is not actually like super important. So I think the point, I don't think this represents like a deep flaw in proof of stake, but it does show what is possible and what is not possible. All right. With that being said, there are interesting invariants to understand about finance, which are very useful in thinking about the system. One invariant is that in general, if you don't have convertibility between two assets, you're not going to have parity. You need to have some convertibility, and it can be very roundabout. But if there's no way to arbitrage the system, if the system is at equilibrium, if you have a system which is not at equilibrium, and you cannot make money by moving it towards equilibrium, then you don't have a stable system. Like that's a general principle, and you can see that in the systems. And then the other thing is you can make thought experiments. So, for example, what happens if there's a chain split? Because if you have no collateral, if there's a chain split, a priori, you've doubled the number of stable coin. Do they still all have value? Because if you don't have collateral, like you have a fork, okay, so do they still have value on both chains? On which chain do they have value and why? And if you try to answer that question, like all of a sudden, if you look at Basis, a priori, Basis should work on both chains. Okay, so now you have a mechanism for doubling the value of money. Okay, and in general, that there are no mechanism for just like magically doubling the amount of money. So you know that you've broken an important invariant if you can just like create arbitrary amounts of wealth from nothing. Okay. The other one that you can break is the following. So people say like, oh, look, I have a system that will replicate the US dollar. Okay, and I said, very well. Can you replicate an asset which is just like the US dollar on day one, and then is worth $2 on day two, and then is worth $4 on day three, and then is worth $8 on day four? I define an asset like this. And, of course, if you're backed by a bank account, that's not going to work. So there's a big difference. But if you are a system that merely consumes a value, if all your input is just like, that's the value of the coin in US dollar, then you should be stable, and if you're stable against one, why aren't you stable against the other? And if you can have an asset that doubles in value, again, you've broken an invariant. So thinking through these invariants is a good way of highlighting like what's broken about the systems, and seeing what can and cannot work. So one of the main lessons is that the best you can do if you do a sort of collateralized coin like Checker, which is what I'm working on, or MakerDAO, the best you're going to have is not a pure peg, but something that either slowly appreciates or slowly depreciates regarding with respect to the underlier. You're going to have basically an instant rate that is either positive or negative that represents the difference with erased. And it's if you're used to finance, I think one way of thinking about this is that if you were replicating this position with a forward and you had like a 1 minute forward and you were rolling this 1 minute forward all the time, each time you roll it, you would either like lose a little bit or gain a little bit. And the rate at which you would lose or gain a little bit with a forward is basically very akin to an instantaneous rate. If you're familiar with this concept, it makes it very, very easy to see what's going on and to see where the mistakes are. If you're not and you're just like looking at this from the outside without having these invariants in head, it can look somewhat convincing. So like, oh yeah, why not? Yeah, I see, like they're going to do this way. And I don't get visas. Like it's just like, the people behind it are just VCs whisperers. It's incredible.
Well, I mean, just again, for the audience, just to kind of explain kind of roughly how basis works. Certainly, I believe ESD worked on this basis. I'm not sure about DSD, but essentially the game is as follows, which is we're going to issue a token. Its target is to be price stable, and we think if the price of the asset goes from, let's say, $1 to $1.20, very obvious how we cure that. Even if very imprecisely we expand supply, okay, that's more or less all right, but you're probably always going to overcorrect. What happens when the value falls below $1? And so that's the kind of the big question. How do you've got to do this through the secondary markets. That's what you've committed. You've said that you're going to have to do this essentially by bribing the markets to bring this back into parity with the dollar. And the answer historically, I think it's fair to say, Arthur, has been we're going to force some lockup of supply, and the reward will be denominated in that same asset through a large supply expansion at some later date. I think in the SD it's 90 days. In basis, I think it was up to 5 years. But fundamentally, we're going to incentivize this lockup, which of course, I mean, to my way of thinking is trading off a problem now for a much bigger problem in the future. And that's that I think it's fair to say is the controversy around the stablecoin. I suppose in answer to some of the points you've just made, the algo stablecoin person might turn around and say, well, yes, but isn't in the event of a let's say a chain split, isn't Maker fundamentally flawed as well because it's going to be under collateralized, or does this not actually ultimately come down to a governance problem at the layer one, which obviously is actually exactly what Tezos does, but could they say everything is a race to the bottom if the network comes under enough pressure?
No, but that's not the issue, because with something like if you have a chain split, right, then clearly like in general, like one coin is going to retain, like if both coins retain 50% of their value, then maybe you're under collateralized everywhere and your system fail. But that's not typically what happens. Like typically you'll have one network keep most of the value and the other not, and one coin will fail on one and the other coin will fail on the other. But that's fine, and you understand why. The problem is that if you follow the logic of basis, there is no reason, if you grant that the basis of logic is sound, there is no reason why you cannot just double the supply and still have the same the same function. So that's it's sometimes this is a case of like the argument proving too much. And there's different variants of the mechanisms that have evolved. In one variant, basically they will say, okay, we need to lock up supply, so we are going to create bonds where you lock up your supply, and then you will receive more money in the future, and that amount raises until people are happy to lock up. And in other versions, they'll say like, no, we'll raise that, but we'll only pay you once we inflate, in which case you don't actually know when or if you're going to repay. But at some point, what happens is you have a break. At some point, you're offering so much money in the future for people to lock up their supply that they will say, no, this is so much issuance that what I will get in the future will actually be worthless, or I don't think there's going to be enough inflation. So the mechanism works for stabilizing fluctuations. If you expect that the demand for holding it is generally going to be rising with like little ups and downs, you can ride the downs like this because you're betting on future demand. But you cannot bet, like if you have anything like a long downtrend on a demand for this, it completely breaks. Sorry. The other way to look at it is that basically you trade off your volatility. It creates two attractors, one at 1 and one at 0. And that's the only, that's why it's so helpful to think of it as like, what if I replace the US dollar with just like something that increases exponentially against the US dollar? What happens here? And what happens here is that very quickly, this thing would just like become huge and then just like start falling. So it's an easy thought experiment to see why the system is flawed.
So the main takeaway of this conversation is we need a redemption mechanism. Could you take us a little bit through the design for your stablecoin that you're building at the moment, Checker?
No, not specifically. So the general idea is this: you have, first of all, is governance minimized. I don't think these things need much governance. You do need an oracle because you're depending on something external, but that's the extent of it. So the general idea is that you place some collateral. Any collateral, and then you're going to issue some stable. I prefer to call it a Robocoin. You issue a Robocoin against it, and then you have a specific target for the Robocoin, and you're going to measure how well it's doing against the target, and you can do that using maybe an on-chain decentralized exchange, for example. So you have a decentralized exchange between your base currency like Tez and between the coin, and then the price of Tez in some alternative currency. So maybe the price of Tez in Swiss franc, and then the price of Tez in your Robocoin. And so based on that, the price of the Robocoin in Swiss franc. And let's say it's below its target. So if it's below its target, then not enough people are holding it, and so too many people are issuing it against it. So what you're going to do is you can raise a variable that I call the drift, which is this rate we're talking about, meaning that instead of now targeting 1-to-1. You're going to say, I want to target 1.001 to 1 tomorrow, and then 1.002 to 1 the day after. You're actually setting a policy where your target is actually going to raise. On the other hand, if it's too expensive, if too many people are holding it, you want to do the opposite. You want to lower the drift and possibly even negative. So you might want to say, look, if you really want to hold this, you're going to be charged. Like this thing is going to actually lose value against the thing it's supposed to be pegged to, because just too many people want to hold it. That's another way to think about it, by the way. If you have a stablecoin mechanism and you wonder, okay, let's say tomorrow, everyone in the world wakes up and decide that they want to put all of their saving into the stablecoin. What happens? Like, how do you not break the peg? And the only way you can do that is by having this negative drift. The drift is what they call the stability field maker. And you need to be able to go negative. If there's more demand for issuing it than holding it, then you're going to have positive stability fee. And historically, it's what happened with MakerDAO, because people use it to get leverage on ETH. People are not so much interested in holding it. They mostly get paid by the people who want to get leverage for holding DAI. That's a regime where you have a positive stability fee. In the regime where people actually say, like, you know what, I'm not actually that interested in leverage, but I would really, really like to hold this stable sort of value because that's so convenient. Then you get into a regime where it's negative. And if you can't go negative, then you're going to start breaking your peg. Right.
So we're going to start to need real sort of negative rates on borrowing pretty soon, and presumably until such point there's a plentiful supply of yield-bearing assets going as collateral into these stablecoin mechanisms.
And that's the beauty part. When it gets negative, is you're saying, like, look, people will pay you to hold this risky assets and mint this less risky assets. And so now you have a natural way of expanding the supply of collateral that can go behind it, because now the collateral, pays you for holding this risky collateral. In some sense, like, there's no greater mark of success for like a collateralized coin like this than having a negative stability fee. Like, the more negatives, the more you've made it.
Makes sense. Great. So we've covered stable coins, and great to hear that not just Checker, but I know there are several stablecoin projects coming to Tezos, which is very exciting. What about sort of thinking briefly, and maybe to wrap up the conversation, around DEXs and whether, to the extent to which people will be able to get decentralized sources of liquidity on Tezos in the relatively near future?
Yeah, so there's a couple DEXs on Tezos which uses a very similar model to Uniswap, at least Uniswap v2 or v1, which is the classic constant product market making system. Very, very simple to deploy. So there's a few of those. And I think we'll keep seeing more. I've been looking at the Uniswap V3 paper, which is interesting. I have a prototype. It's a nice generalization of Uniswap.
I thought you might. So I think it's right to say the V3 of Uniswap looks something like people liquidity providers are able to kind of put brackets around where they're prepared to provide liquidity to the market in terms of price. Is that going to at some point? Is this the first step towards us being able to create decentralized exchanges which have a little bit more expression around them? Look something closer to a conventional order book.
Yeah, and by the way, I'm a big fan of double auction, continuous double auction order books. I think they're great, and I think it's where the market has generally converged, and I think it's what is the most efficient. So why is there so much success for Uniswap? I don't think it has anything to do with per se the fact that look, it's not an order book. That's mostly a limitation of the blockchain model. I think the killer feature is permissionless liquidity. A ton of people want to launch a lot of dubious coins, and historically they have to pay $1 million to CZ so that their coin can get traded. And now no longer. Now what they do is they set up a yield farming system where people get paid for providing liquidity to the coin itself, and that has been it's called DeFi. I wouldn't call it, I think it's a bastardization of the term, but it's what now people refer to as DeFi. So permissionless liquidity has been the killer feature, but I don't think it's necessarily the shape of the Uniswap curve itself. That's too saying. It's just the fact that it was extremely gas efficient and it was extremely simple and clear, and a lot of decentralized participation in it. That was a killer feature. If we lived in a world where people could start and open exchanges and operate them easily anywhere in the world, I don't think we would have seen that. I think we would see centralized order book. So, the killer feature of Uniswap is decentralization. It's not being a continuous order book. And I know that's a big selling point. There's some high throughput chains which say no, look, we're so high throughput and so low latency that we're going to be able to run real order books. I also don't think the benefit of order books is just so high that somehow it's going to completely squash Uniswap. It's not like these sites have this very well-defined prices and you need this fine-grained price discovery for tomato coin. Tomato coin is going to trade where it's going to trade. And to be honest, there's not the difference is that detailed order book probably need professional market makers who are used to placing orders, whereas a lot of these things have just people adding liquidity without necessarily understanding what they're doing, and so as a result, they get more. They see more liquidity.
Well, I guess the learning of the past year, or at least the experience of the past year, is people they've been very insensitive to frictions and trading costs, and just the improved, as you say, permissionless UI. I don't have to give my passport out to anyone is extremely valuable. So, as a final question, Arthur, I'd like to hear from you a little bit about where's Tezos going to sit in the future decentralized finance industry, and particularly when are we going to see a significant growth in facsimiles of existing capital sources? So I'm thinking about things like conventional debt, conventional equity. We're seeing obviously, I know some synthetics of those on Ethereum and perhaps on Tezos. Can you talk a little bit about how you think those interactions are going to occur over the next 2 to 3 years?
Yeah, so Tezos is now starting to see its share of fruit coins and this type of farming stuff. But it used to be that DeFi meant decentralized finance, and they made things like MakerDAO, and they made things like Augur, which I think are really good projects. And the term has come to mean something completely different, which I find I don't think farming tomato coins to get more concurrent coins that you can use to trade tomato coins is finance. It's not the future. People will say oh look, I'm making 200% yield. That's the future of finance, because in the other part of finance I don't get to 100% yield. Right. So I think that's nonsense. So the thing that is not nonsense is a permissionless liquidity aspect. I think that's very I think that is very important. The question is how many permissionless assets can we really have on the market that makes sense? And I think cryptocurrencies make sense as permissionless assets. Maybe some application tokens can make sense and can be sustained, but there's not that many of these permissionless assets. So now we are back at looking at more permission assets such as tokenized debt, tokenized equity, tokenized gold. And I think there's going to be a strange interaction. Like the question is, does it make sense to have permissionless system for permissioned assets? Potentially, I'm willing to see it play out. I'm not ruling it out, and there are people doing hybrid things. So I think Realty, for example, is one such example where they're using something like Uniswap, but with permission users and permission assets. So it's not out of the question. I think that I'm hoping that Tezos is going to be the chain basically where we see real applications. So if everything that you're doing is basically just like internal to the chain and you're not actually like providing any type of financial service to anyone else, then I will say that what you're providing is entertainment, a polite way to say gambling in some sense. If you want to see real financial services, I think that, so lending against cryptocurrencies, that's a real financial service. People actually benefit from that. I would love to see some form of uncollateralized lending, non-recourse loans, which is very hard to do on blockchains because they're all about trustlessness and no central body of enforcement, and unsecured debt is very much about trust and enforcement. So it's a tough one to crack, but I think there's interesting aspects from trust, trust networks, webs of trust that could potentially be used for that. Insurance is another one that I find super interesting. Decentralized peer-to-peer insurance could be quite useful. And of course, you see some of that in prediction markets. And again, so I think Tezos got a little known in 2019 for some STOs, and there's several large issuers of STOs who are using the Tezos chain. I think it's a little still early for STOs, and they will really come into play when you have these different bits interconnecting. And there's two ways to see the permissionlessness. One is, haha, this is a blockchain. It's completely decentralized. You can't control it, and people who want to censor it can't attack it. So that's a strong form of permissionlessness. And the other one is a little weaker. It's not about censorship resistance. It's more about the fact that it's open to everyone's creativity. Like anyone can create something, and because of that, you have a more vibrant ecosystem, and that can be more compatible with this more not trustless assets. So there's an opening here. So I would like to see some of these DeFi primitives that were invented, and they are really interesting concepts like perpetuals. That's an innovation in the crypto world. Perpetuals. Constant formula market making contracts being applied to some of these non-permissionless assets. There's a bit of an impedance mismatch, but I think it's possible, and I'm hoping that's exactly what we're going to see on Tezos.
Great. Well, thank you very much. Are there any other things you'd like to say in terms of appeals to engineers, or anything you'd like the audience to know about Tezos before we sign off?
Tezos is a really cool project that's really growing a lot and very fast now. The number of smart contract calls has been tripling for the past few months, every month. And so, all of a sudden it's stress testing the system, stress testing the libraries, the services. And so it's a little bit all hands on deck. And so if you're interested in building, it is really, the ecosystem is really starting to strive in terms of adoption. So I think it's a great time to jump in if you've not really been paying attention to the project.
Well, Arthur, thanks very much for coming on. It's been great to speak. We've touched on a lot of subjects in a relatively brief way, in which we could have kept the conversation going for a few extra hours. But thank you very much for coming on Real Vision.
Thank you for having me.